Welcome, everyone, to what I wish I knew about financial planning, but no one ever taught me. My name is Colin Clark. I'm the Senior Vice President of Retirement here at Washington Financial Group Hub International. And I'm really excited again to be joined by Jay Sanford, our Director of Investment Strategy here at Washington Financial Group Hub. Jay, welcome back.
Thanks, Colin. It's been fun so far. I'm confused at the title of this podcast. It keeps changing. I was told that you wrote it down this time, so let's see if it sticks.
Yes, and I'm sure I'm going to hear from our producer, Mr. Jeff Pincus. He will give me a hassle about that, but hopefully by the third installment, we'll have it straight. But yes, I do hear a lot from people. I wish these are things that I was taught about in school, and until recently, and I have 4 teenagers. It's part of their curriculum now to take a semester in financial planning, retirement, investing, and in finance. So I'm very pleased that the next generation coming up has a foundation. But Jay, we deal with lots of folks, especially in this pre-retirement phase, that I think we took typing and check writing in high school. And that's not really helping me when it comes to asset allocation in stocks and bonds. Is that fair?
Yeah, it's a great point. You and I are about the same age, even though we probably have about the same amount of hair actually as well.
This is a podcast.
Which is receding. So, yeah, totally. I had typing when I was in 10th grade and did not have, an investment class. Did have, an economics class, but it really didn't go into the nuts and bolts of investing and that sort of thing. So I think, financial literacy is a huge buzzword right now, and it is starting to be taught younger and younger. But I think it's also good to have these types of podcasts out there so people can reference them when they have some questions.
No, that's perfect. And, in the first part of the series, we talked about the growth phase of your investing and financial life. Now we want to talk about the pre-retirement phase. And I know you defined what asset allocation is. Maybe if you can just define asset allocation again, and then just segue into, what does it look like for someone who's getting ready for retirement? I have these conversations all the time with folks that are, in their mid to late 40s, 50s, and they're starting to think about, what it's going to be like to not have a paycheck anymore.
Yep. Yeah. That's scary. Yeah. So, in the first installment, we talked about the growth phase, asset allocation. Touching on asset allocation, it's just the diversification of assets within a portfolio, usually based on risk. So, you have not all your eggs in one basket. If you're in all equities, you still should have different types of equities. If you're in all bonds, you should have different types of bonds, and then you meld them all together, and that's your asset allocation. The nomenclature that we're using here, the growth, the pre-retirement, and we'll touch on retirement in a future podcast, but that nomenclature really is just based on time. So we talked about the growth phase, and growth really meant 7 to 10 years plus in terms of when you're trying to reach your goal. And when we talk pre-retirement, your goal is closer. And so that basically means in our world here at WFG Hub International, pre-retirement is basically 3 to 5 years out from retirement and or your goal. Your goal could be going to college. Your goal could be buying a boat, buying another house, buying a new house. So really what we're talking about here is the timing of your goal and when you'd like to achieve it. Pre-retirement, like I said, then is we look at it as 3 to 5 years away from your goal.
Okay. How do I know what my risk is, or some people call it risk tolerance? Like, what tools or things are out there for me to learn about how I really feel about investing?
Yeah, measuring risk is a tough thing. Just, there are technical ways to measure risk. A standard deviation, which is the chances of it going up a certain amount can be, and what the chances of your investment going down a certain amount can be. That's your standard deviation. It should fall within a range of that. There are Greek letters that are sometimes, alpha, betas, R squareds. Those are all things that you can use towards measuring risk, whether it's a singular investment or a mutual fund that you're in or an overall portfolio. That's how you could measure risk. Now, the question is, what risk should I be in if I am getting closer and closer to the goal? And we can talk in generalities towards retirement. And so at that point, we talked about the growth phase before, and that we know that in any given time, if you're in all equities, you could be up 20 or down 20. When you get closer to the goal, you lose time. And what time does for you is it averages out the ups and downs and gives you a final number down the road. When you only have 3 or 5 years to your goal, you've lost that time. You've lost the ability to average out the bad years with the good years because they can be random. In 2008, we were down 36%. In 2009, we were up 47%. You don't know when those years are going to come. And when you are close to retirement, you have a goal to get to in order to have that nest egg or have that ability to go to college. And you don't want that nest egg to necessarily disappear based on a singular year or a bad 2-year stretch. And so that's when you must reduce your risk so that you don't have those high or large swings up and down as you get closer to your goal. Asset allocation wise, what does that mean? Well, that means going into less risky assets, certain bonds. If we're talking about 401ks, starting to get into the stable values, continuing to diversify into real estates and broadening your asset allocation to reduce the overall volatility of your portfolio so that you're going to hit your goal in 3 to 5 years.
That's really important, but I really want to get real now. So I have conversations with people that kind of fall into 2 major categories. There may be someone listening to this podcast right now that they don't think they have enough saved to enter that retirement phase. And then there's people who probably have saved enough for the retirement phase, but they still may not know that. So can you address both those categories and how you would maybe adjust their asset allocation?
Yep. So the first thing, and obviously I'm biased, Colin's biased, we're biased here, is that I think it makes sense to have someone to talk to about this. Going at it on your own, unless it's your passion and you kind of know exactly what you're doing and know what you want. We certainly see those types of people, and more power to you. But most people fall in the category of, it would be nice to be able to talk this through with someone. So that would be my first recommendation is find someone you trust, talk it through. Second one is know what the goal that you're wanting to get to, and then figure out if your nest egg, in this instance, your 401k or whatever, it is at that level. And if it's not at that level, unfortunately, getting real here with you, Colin, it's very counterintuitive. If you want to have a nest egg of X and you're not there, then you're going to have to take more risk in order to get there, or save more, right? There's 2 sides of that equation. It's save more or risk more in order to get higher returns. And so in your example, the first category is I have this nest egg. I want to live off of $60,000 a year. Is this enough? And if the answer is no, well, you're going to have to risk up. You're going to either have to save more or work longer. In the second case that you gave, is this enough? Yes, it is. Okay. And so at that point, you want to match the risk and the asset allocation to making sure that you can maintain that goal. And in this instance, that random number of $60,000 a year.
So sometimes you think you might be a bit more conservative. If you feel like you've reached your goal, you're on track for your goals, maybe you start to de-risk your portfolio a little bit.
Yeah, you can de-risk it. You do have to realize that, we used to say that people are living longer, but we know the mortality rate's actually going down a little bit in the United States recently.
A little bit, yeah.
But anyway, you do have to realize that de-risking doesn't mean getting rid of all risk. And you're going to have to maintain your portfolio for another 10, 20, 30 years down the road. And as you said before, inflation can erode in that if you get too conservative. And so, yes, you can de-risk some, but it certainly do not de-risk at all because it does need to last.
Well, Jay, this has been great. I really appreciate you kind of going over risk tolerance and what people who are in pre-retirement should be thinking about. Stay tuned, everyone. We have a third segment coming about how to deal with asset allocation in retirement. So for the time being, we'll look forward to seeing you next time on the What I Wish I Knew About Financial Planning, But No One Taught Me podcast. Thanks, Jay.
Thanks, Colin.
That's going to do it for this week's show. Thanks for listening. If you enjoy our show, we'd love for you to subscribe on iTunes or wherever you access your podcasts.
There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. No strategy assures success or protects against loss. Investing in stocks includes numerous specific risks, including the fluctuation of dividends, loss of principal, and potential liquidity of the investment in a falling market. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, and bonds are subject to availability and change in price. Alternative investments may not be suitable for all investors and involve special risks such as leveraging the investment, potential adverse market forces, regulatory changes, and potential liquidity. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Global Retirement Partners LLC, a registered investment advisor. Global Retirement Partners, Washington Financial Group, a division of Hub International Mid-Atlantic, and Hub International are not affiliated with LPL Financial.
And now, let's hear a little bit of the audio that didn't make the final cut.
So hopefully we've got it. The 7+ 5 years, kind of the what the up the
Okay, so that's